we have an excellent friend of mine, Nouriel Roubini. I know him since 2009, 2008. You remember that Depression era, right? He was called Dr. Doom, but he is quite optimistic these days. And he's going to discuss the supremacy of US dollar. So Nouriel, on this note, thank you. Thank you all for coming.
Good morning, everyone. Great being here today. Thank you, Vidak, for inviting me. Yeah, the official title of my talk is Why American Exceptionalism is Not Over, nor the Exorbitant Privilege of the US Dollar. Why do I want to talk about this topic? Because if you look at what happened after the April 2nd liberation tariff were announced, the overall consensus and the conventional wisdom about the US economy suddenly became pessimistic. If you look at most of the sell-side research, their baseline was one of, because of this very high tariff averaging 30% rather than 3%, they would have a US and a global recession and a surge of inflation in the United States, point number one. In this new conventional wisdom, even the Goldman Sachs or JP Morgan of the world started having that baseline. Secondly, people said that the US was shooting itself in the foot at the American exceptionalism that had been growing much faster than all other advanced economies is going to be over. Third, people made the argument that the stock market was in a bubble and it's going to crash because of all this stagflationary policy will lead to recession and inflation. Four, people said that because we have large twin fiscal and current account deficit, the trajectory of our public debt and external debt as a share of GDP will rise and become unsustainable. Point number 5 in this new conventional wisdom was that because of, again, weaponizing the dollar and doing policy that would scare foreign investors, the exceptional privilege or the exorbitant privilege of the US dollar as a major global reserve currency will be soon over. And 6, as a byproduct of the 5th point, that the US dollar is going to start to fall in a free fall way because we had massive capital outflows out of US assets. Now, usually I tend to be pessimistic. They even call me Dr. Doom, but I took a contrarian view. I guess I'm always a contrarian. When people are optimistic, I'm pessimist. When people are pessimists, I'm optimistic. But no, truly so, I thought that this new conventional wisdom was very pessimistic about the United States, was misguided. And I'm going to go through quickly, because we don't have much time, each one of the various points. Point number 1, why I said that there'll be only a slowdown of growth recession, meaning a growth by Q4 below trend for a couple of quarters, and then we're going to recover. Why would avoid a US recession and why there will not be a surge on inflation? Now, if that tariff announced that were over 30% were to be implemented, of course, that would have led to a recession and to a surge in inflation. But then the argument there were 3 forces that are going to constrain Trump and his more stagflationary policies, both on trade, on migration, and other things. Point number 1 was market discipline, most important. Secondly was the Fed independence. And 3, having economic advisors. And the most important one is market discipline. Guess what? 2 weeks after April 2nd, the NASDAQ was down 20%. The S&P 500 was down 15%. Bond yields for 10-year Treasury went up by 80 basis points. High yield spread went up by 150 basis points. And the dollar started to fall quite sharply. So that was exactly market signaling and saying, reaction, we don't like these tariffs, and punishing the administration. At that point, Scott Bessent goes to Mar-a-Lago and tells the president, listen, I told you in advance that if you escalate so much, the market reaction is going to be terrible. We'll have a recession, inflation, and your MAGA plan is going to be dead on arrival. We're going to even lose the midterm. So what do you want to do? Do you want to double down, or you want to blink and start negotiating trade deals for tariff levels that are lower than 30% average? And guess what? Trump blinked. People say chicken out. Talo, Trump always chickens out. And he gave mandate to Bessent to negotiate tariffs that are much lower. We know that market discipline works in emerging markets. It works even in advanced economy. We saw it in Greece, in Italy, in France. In UK, Liz Truss did not stay in power more than 44 days because she did a fiscal stimulus the market didn't like. Bond is up, the currency down, stock market crashes, and then she had to get out of power. Now, when I was in the White House during the Clinton years, the main political advisor of Bill Clinton was at that time, Jim Carville. And Jim Carville famously said one thing, half a joke, but he said, if there is reincarnation, in my next life, I don't want to be reborn as the president of the United States or as a pope, allegedly the two most powerful people in the world. I want to be reborn as the bond market so I can go around and intimidate everybody. Literally, the bond vigilantes are those that impose market discipline. In this case, it was the bond vigilantes, the stock market vigilantes, the credit vigilantes, and also the stock market vigilantes. And they forced him to blink. Now, 15% average tariffs is not great compared to trade. I believe that protection is bad, but it's something that's going to lead to a slowdown of US growth, and is leading to a slowdown of US growth, leading to a global slowdown, leading to some uptick in inflation. But I think it's going to be not even a short and shallow recession, just a growth recession, as I predicted, because the market forced him essentially to blink. Point number two, why American exception is not over. And people said this economic policy are going to lead to disaster, not just trade, migration, unfunded fiscal deficit, breaking the rule of law, weakening independence of the Fed, and so on. Since April 2nd, I've said something, there's a little bit of a slogan. It says, tech trumps tariffs. And what do I mean by tech trumps tariff? I believe that the technology innovation that we're seeing today are the most important in human history, literally. And while everybody's obsessed about the Gen AI and machine learning, it's only one part of the piece. There are a dozen or more industries of the future that are going to boom in the next few years. Is AI machine learning, a new version of it? Is semiconductors, robotic automation and humanoid robots? Biomedical research going to make us live healthier and longer? It's going to be a spatial exploration and exploitation, quantum computing and its merger with AI. In a world of geopolitical depression, everybody is going to spend more on defense, but the nature of defense is becoming defense tech, as we saw in the war between Russia, Ukraine, or Israel and Iran. So it's defense tech. In energy, it's not just renewable and clean tech and green tech, but it's going to be also a revolution in fusion, a new form of energy, gives an unlimited amount of energy, zero greenhouse gas emissions, and there is nothing like a radioactive uranium to dispose, like in the case of nuclear fission. This is a nuclear fusion. Then you have fintech, you have agtech, you have new cryptography, new material science. So there can be an explosion of new technology of the future. And I've argued, and I'm not going to go into detail, that I think that in a good optimistic scenario, potential growth in the United States by the end of this decade is going to be closer to 4%. The official estimate is 1.8 to 2%. So you have an upside of 200 basis points of growth. And it's going to accelerate further in the next decade as we're going to reach eventually from AI also AGI, artificial general intelligence. Now, what is the maximum negative impact on growth that bad policies, stagflation like trade, migration, and so on can impose? I looked at the estimates, and given the reasonable amount of tariff we've seen, is maybe 50 basis points. So you have an upside of 200 basis points, you have a downside of 50, ratio of 200 to 50 is 4 to 1. So tech trumps tariffs. So tech is a first-order effect on potential growth, while all the other stagflationary policies have much less of an impact on potential growth. So that's why American exception is not over. It's not over because if you do believe that US was in American exceptionalism when the official estimates of potential growth in the US were only 1.8%, in a world we're going to go towards 3 and then 4 in the next few years, of course, American exceptionalism is going to be even more relevant. So this idea that US is doomed when US is number one in the technology of the future, I would say is US and China in this dozen of technology. We can discuss which one of them is US ahead, which one of them is China. By the way, it's not a zero-sum game. Both of them can benefit because it's their general purpose technology, that one benefit the other. But it's US and China, everybody else comes after. After you have, of course, Japan, you have Israel, you have India, you have South Korea, Taiwan, even some pockets of excellence in Europe, but Europe is way behind. So it's a story between US and China. I think both of them are going to do well for a reason I'm not going to discuss right now. I think US is going to do better in some of the more critical technologies like AI, semiconductors, quantum, fusion, defense tech, and you name it. So American exception is going to become even stronger rather than weaker in this scenario. Third point, If it's true that potential growth is going to go from 2 to 4, and if it's true that when average potential growth was only 2%, the S&P 500 was giving you returns historically of 10, 12%, then it's very hard to be pessimistic about the US stock market and say it's in a bubble. Of course, there will be corrections because probably there'll be some excesses and there'll be a correction. There'll be winners and losers. The winners and losers are going to be both within the existing firms, those who don't innovate and adapt to the new technology might be disrupted and become obsolete. Look at what happened to GE. There was a huge multinational and then missed the boat on some technology, now declined. And there'll be also winners and losers within the AI space. Basic LLM are going to become a commodity. But the future of AI is not Gen AI correlation, but is actually causal ML inference, like scientific inference, like what I get to once we are close to AGI. So there are lots of new stuff happening. But of course, even among the AI firms, many of them are going to go bust because like any situation, there are winners and losers. But in a world in which US growth is 4 rather than 2, average returns on US assets should be even higher than they were historically, in spite of the fact that there'll be winners and losers and there'll be some correction in the market from time to time. So I don't think that the stock market is in a bubble and is going to crash. I don't say it's going to linearly go ahead with returns double digits every year. There'll be frothiness, there'll be some correction, but if you take the medium long-term view, if American Exception is going to double down from 2 to 4% growth, the stock market return, especially in the firms and the industries and the sectors of the future, are going to be very high. Some of these firms are in the public market, some of them are in the private markets, but many have access to both. Point number 4, if you look at the CBO, the Congressional Budget Office, estimates of what US public debt is going to be as a share of GDP or even external debt, they show that US public debt with budget deficit this year of 7% and being closer to 5-6 for the next few years is on an unsustainable path. Eventually it's going to be going all the way even towards 150% of GDP. And people worry when that's going to be the case, eventually something is going to happen. Market discipline with spread widening. We might need to monetize it. We're not going to have debt default because US can monetize it. But they say it's unsustainable. But what is the assumption that the CBO makes about US potential growth? The assumption is that US potential growth is only, for the next 2 decades, 1.8%. So not very different from what the potential growth has been in the last 20 years. However, the CBO does a scenario analysis where they say, let's assume, just hypothetically, the US potential growth is not 1.8%, but is 2.3%, just 50 basis points higher, an epsilon greater than that. Then what happens to public debt to GDP? It goes up for the next 20 years somehow, and then it flattens out. Because, of course, debt to GDP is debt relative to GDP. If GDP is growing faster, the denominator, then the ratio is going to flatten out, and the deficit is going to shrink over time. Now, this is flattening out in 20 years if the potential growth is 2.3. If it's not 2.3, but 2.5, 3%, 3.5, let alone 4, then, of course, the ratio is going to fall over time quite sharply. Now, you might say, well, we have a bias towards spending. If the deficit is going to shrink, the political system is going to lead to eventually spending more. That's a risk. Or we could say that eventually with permanent technological employment coming from AI, we have to widen the social safety net, maybe UBI, and unless we tax the winners to redistribute to everybody else, the deficit could go larger. Fair enough. Those are valid points, but the point is that given the current trajectory of policy, the debt to GDP ratio doesn't explode in a world in which growth is 3. Of all the solutions to a debt problem, as we know, debt of a household, debt of a firm, debt of a country, domestic or external, the best solution is to grow the denominator, income, revenue, profits, GDP. And therefore, if you have a more optimistic scenario about US growth, then the concerns about the sustainability of public debt or even external debt are not as severe. Guess what? The 10-year Treasury is still at 4%. Why is it so low? In spite of this concern about the deficit, maybe because people realize we are on a different growth path. So I'm not saying we don't have fiscal problem, but compared to those of countries like Europe, where potential growth is 1% of GDP, and unless they innovate, they're going to stagnate at 1%, I think the problems of Europe are more severe than the United States or Japan, for example, in terms of that sustainability. Point number 5, people have said that with American exceptionalism being over, and we have us having weaponized the US dollar for national security and foreign policy purposes, and with all this talk even about a Mar-a-Lago agreement that should lead to a weakening of the dollar because the dollar is too strong, or even people talking about imposing taxes on capital inflows in the US because we don't want excessive appreciation of the dollar that leads to deindustrialization. People said all this kind of signal implied that people are going to want to diversify away from dollar assets. If you're a rival of the US, say China, and you're seeing what the US has done to Russia, to South Korea, to Iran, then you know that you might be also sanctioned. And as they say, if I owe you $1 billion, it's my problem. If I owe you $1 trillion, it's your problem. So China having so many dollar assets is risking them to put them in a situation of fragility and so on. And it's not just the rival of the US, but even those who are the frenemies of the US are worried that if we impose primary sanction on China and then they don't follow it, the South Africa, Brazil of the world, they'll be subject to sanctions. So everybody wants to diversify out of the US dollar. That's the argument for why there'll be de-dollarization and the role of the dollar as a global reserve currency is going to be over. However, you cannot replace something with nothing, point number 1. And point number 2, if you don't like the dollar, what is the alternative to the US dollar? And my former advisor at Harvard, and he was my boss when I was at US Treasury, Larry Summers, famously said, it was a bit of a joke, it was not a nice joke, but he said, people don't like the dollar, but what's the alternative? He said, Europe is a museum, China is a prison, Japan is a nursing home, and Bitcoin is an experiment. So people don't like the dollar, what's the alternative? Important point about it. Additionally, ask yourself what's going to happen to the US current account deficit, our trade deficit. In spite of the tariffs, it's not going to shrink. It's not going to shrink for the following reason. From a macro point of view, the current account is the difference between national savings minus national investment as a share of GDP. The current account is a share of GDP. Savings, private and public in the US, are not going to fall very much or increase very much. They're stable. But investment is going to have a boom. Capital spending is going to boom because of the AI and the industries of the future. So if you have an investment boom and savings are the same, by definition, regardless of what tariffs are, your current account is going to become bigger. It's like a firm that is a growth firm, has lots of capex investment, doesn't have internal savings, meaning retained earnings, and has to borrow equity or debt in order to finance that investment boom. Or an emerging market that discovered natural resources has to invest into it, and initially you have a current account deficit because investment goes up and savings are similar or not changing. So US is like a growth firm, or an emerging market is in a boom. So the current account is going to widen, but this wider current account deficit is going to be financed by inflow of capital. In my view, more equity than debt. Could be FDI, greenfield or brownfield, could be venture capital, could be private equity, could be portfolio investment, but it'll be a massive inflow of FDI to finance this current account deficit. A lot of it is going to be equity rather than debt. So among the foreign liability of US, the equity ones are going to rise more than the debt. And that's why they're going to be more sustainable, because the return then are going to be able to pay back the investors. So current account deficit is not going to shrink, even with tariffs, just because from a macro point of view, we have an investment boom, and therefore the inflow of capital into dollar assets is going to continue, and therefore the exorbitant privilege of the US dollar as a major global reserve currency is not going to be over. Final point I'll make on the US dollar. This year, the US dollar has weakened. All this talk about weaponizing it, politicizing the Fed and trying to reduce independence, and maybe the Fed's going to cut interest rate too much too soon. A bunch of cyclical factors. And the euro that was almost at parity with the dollar beginning of the year is now, depending on the day, 117. It's gone up by more than 15%. But think of it in the medium-long term. In the medium-long term, the real value, the real exchange rate of a currency depends on growth and productivity differentials. If a country growing faster the real value of its currency in real terms has to be appreciating over time. So look forward, not today, 5 years down the line. US growth is going to be 4%. Eurozone growth is going to be stuck around 1%. And therefore, massive amounts of inflow of capital are going to come US to finance our economic boom. The dollar is going to become stronger, not weaker. And actually, the euro has to become weaker in order to gain some competitiveness through exchange rate. So in the short run, the dollar weakness may continue. But over the medium term, I think the dollar with exorbitant privilege remaining, with American exceptionalism remaining, with growth accelerating, with the returns to new firms and existing one accelerating, the dollar can strengthen over time. So the pessimist that says the dollar is going to be in a free fall for the long term, I think, is unwarranted. So these were the 6 elements of the new conventional wisdom, pessimistic, and I gave you one by one in a very quick, short way why I think that there is conventional wisdom is negative about the US is wrong. American exception is not over. The exorbitant privilege of the US dollar is not over, even if the road is going to be bumpy, because of course there'll be correction, there'll be noise and so on. But the medium term looks, in my view, bright for the United States. Thank you.
So I have 2 follow-up questions for you, Nouriel. So thanks so much for such an insightful assessment of global financial system and US dollar and the technology. So the two questions I have is, many analysts argue that the US economy is financially overextended. What structural advantages allow it to continue defying these warnings?
Okay. Well, I think that, I wrote entire books about debt crisis, and also my last book, Mega Threat. The first 2 chapters were on unsustainable debt. So the first one actually was titled The Modern Debt Crisis. Now, if you look around the world, there's been a build-up of both private and public debt. Public debt, official debt, and unfunded liability coming from aging. Private debt could be the debt of household sector, the debt of the corporate sector, the debt of the banking system, and now, because we regulated banks after the global financial crisis, the non-bank financial institution or shadow banks. So by some measure, there has been a significant increase in the debt ratio. And in the US, debt of household has become somehow lower. Debt of the banks has become lower because we imposed a regulation, Basel III, on liquidity and capital. While there has been a surge of corporate debt, of the debt issued and the borrowing by the shadow banking system, of course, build up of public debt. And people worry that there will be eventually a potential for a debt crisis. However, there's a difference between some individual entity going bust, and we've seen, even the last 2 weeks, some firms that invested or were in the car loan business and those lending them money getting in trouble. But individual episodes of credit problem will occur. The question is, are you going to have a systemic debt crisis? And in my view, as long as the US economy grows, even if you have balance sheet problems because some sector and some firms have excessive debt, again, income, profit, revenues are going to grow, and therefore you need to have a severe recession for a balance sheet problem become then a trigger for a more severe recession and a debt crisis. And since I'm optimistic about US economic growth, I think that credit events are going to happen, but they'll be isolated. They're not going to be leading to a systemic debt and financial crisis.
Thank you, Nouriel. Thank you.